So, you've heard about the currency carry trade, and it sounds like a slick way to make some easy money, right? Borrowing low and investing high? What could go wrong? But what if I told you that the carry trade is like walking a tightrope over a financial chasm? One wrong step and you could plummet into disaster. Let's delve into why the carry trade can be perilous, especially in the context of Japan and the US in 2024. What is the carry trade? First off, what exactly is the carry trade? Imagine you could borrow money at next to no interest and then invest that money where the interest rates are higher. The difference between the low borrowing costs and the higher investment returns is your profit. Sounds simple, doesn't it? That's the essence of the carry trade. In 2024, Japan's interest rates remain extraordinarily low, a continuation of its decades-long policy to spur economic growth and combat deflation. On the other hand, the US, grappling with persistent inflation, has significantly higher interest rates. Investors are borrowing in Japanese yen, where interest rates are almost zero, and then converting these funds into US dollars to invest in higher-yielding assets. But why is this strategy dangerous? The answer lies in the volatile interplay of global financial markets and the inherent risks of currency fluctuations. Who benefits and who loses in a carry trade? On the surface, it seems like a win-win situation for the investor. However, the true story is more complex. The primary beneficiaries are the investors who successfully navigate the currency risk. On the flip side, the losers can be numerous, from small investors caught off guard by rapid market changes to entire economies destabilized by sudden capital flows. When engaging in a carry trade, you are not just betting on interest rates, you're also making a big gamble on currency exchange rates. Let's say you've borrowed yen and invested in US Treasury bonds. If the yen appreciates against the dollar, your returns can evaporate. You'd have to pay back your yen loan with more expensive dollars, eroding your profit margin or even causing losses. In 2024, the geopolitical climate and economic policies are making currency markets particularly volatile. Trade tensions, shifts in monetary policy, and economic data releases can all lead to rapid and unpredictable movements in exchange rates. The carry trade, therefore, becomes a risky venture, akin to trying to juggle flaming torches while walking on that tightrope. Why would investors continue this risky game? The lure of high returns is undeniable, but here's the catch. Interest rate differentials can change rapidly. For instance, if the US Federal Reserve decides to cut interest rates due to an economic downturn, the attractiveness of the carry trade diminishes. Conversely, if Japan's central bank decides to hike rates, the cost of borrowing increases, squeezing the profits out of the trade. In 2024, the global economic landscape is uncertain. The US Federal Reserve is navigating a complex situation with inflation and growth concerns, while Japan's economy is showing signs of recovery, albeit slowly. Any shifts in monetary policy on either side of the Pacific can make the carry trade a risky proposition. All this being considered, if you're intrigued by the carry trade and wondering how to practically implement this strategy, it's like setting off on a financial adventure, seeking to exploit differences in interest rates between countries. But how do you embark on this journey without getting lost along the way? Let's break it down step by step, ensuring you understand every twist and turn of the carry trade. Who should consider the carry trade? The carry trade is typically pursued by seasoned investors and financial institutions who have a deep understanding of market dynamics and the risk involved. However, if you're an aspiring investor eager to learn, you can start on a smaller scale, always mindful of the risks. What currencies should you choose? The key to a successful carry trade is selecting the right pair of currencies. Look for a country with low interest rates for borrowing, the funding currency, and another with higher interest rates for investing, the target currency. In 2024, Japan's yen continues to be a popular funding currency due to its near-zero interest rates, while the US dollar remains a lucrative target currency thanks to its higher interest rates. Where do you start? Begin by setting up accounts in both currencies. This typically involves having a Forex trading account with a broker that allows you to trade currencies. Ensure your broker offers competitive spreads and leverages and has a solid reputation. You'll need access to both margin accounts to borrow funds and investment accounts to place your trades. When should you borrow and convert? Timing is crucial. Monitor the market for favorable conditions. Once you've identified an optimal moment, You can proceed to borrow funds in the low interest rate currency, for example, yen. Then convert these borrowed funds into the high interest rate currency, for example, US dollars. How do you invest the funds? With your converted funds in hand, invest in high-yield assets. These could be government bonds, corporate bonds, or even high-interest savings accounts in the target currency. The goal is to earn a return that exceeds the cost of your borrowed funds, generating a profit from the interest rate differential. Why is hedging important? Currency fluctuations can turn your profitable trade into a loss. To mitigate this risk, consider using financial instruments like options or futures contracts to hedge your exposure. Hedging can protect against adverse currency movements, although it may slightly reduce your overall returns. What ongoing actions are required? The carry trade is not a set-it-and-forget-it strategy. Continuous monitoring of interest rates, economic indicators, and geopolitical events is essential. These factors can influence currency values and interest rates, potentially impacting your trade. When should you exit the trade? Knowing when to exit is as important as knowing when to enter. If market conditions shift, such as a narrowing of interest rate differentials or increased currency volatility, it might be time to unwind your trade. To close the trade, you'll need to convert your invested funds back to the funding currency and repay your loan. Practical example, Japan-US carry trade in 2024. Let's walk through a practical example using the Japan-US carry trade in 2024. Identify the opportunity. You notice that Japan's interest rates are at 0.1%, while US Treasury bonds are yielding 4%. Set up accounts. You open a Forex trading account with a reputable broker. Borrowing. You borrow 10 million yen at 0.1% interest. Converting funds. You convert 10 million yen to approximately $75,000 USD, assuming an exchange rate of 1 USD equals 133 JPY. Investing. You invest the $75,000 in US Treasury bonds, yielding 4%. Earnings calculation. After 1 year, your bonds earned $3,000, 4% of $75,000. Repaying the loan. You need to repay 10,000 yen, the borrowed amount plus 0.1% interest. If the exchange rate remains stable, you convert your $78,000, initial investment plus interest earned, back to yen, getting 10,374,000 yen. Profit. Your profit would be 364,000 yen minus any transaction costs and hedging expenses. How does the carry trade impact broader financial stability? Picture this. A large number of investors decide to unwind their carry trade simultaneously due to a sudden market shock. This mass exodus can lead to a rapid depreciation of the currency being borrowed, in this case the yen, and an appreciation of the currency being invested in, the dollar. Such movements can trigger a cascade of effects, destabilizing financial markets and economies. For instance, if economic data suddenly indicates a stronger than expected US economy, the Fed might raise interest rates faster than anticipated. Investors would rush to unwind their yen borrowings, leading to a sharp appreciation of the yen and a sell-off in US assets. This chain reaction can cause significant market turmoil, affecting everything from stock prices to bond yields. History is replete with examples of the carry trade causing market dislocations. The 1998 Asian financial crisis was partly exacerbated by the unwinding of carry trades. Investors who had borrowed in yen and invested in Asian assets found themselves on the wrong side of currency movements, leading to massive capital outflows and economic instability in the region. Today, the stakes are higher. The interconnectedness of global financial markets means that a disruption in one region can quickly spread to others. The Japan-US carry trade is a ticking time bomb that could, if triggered, lead to significant market upheavals. So how can you navigate these treacherous waters? Well, firstly, don't do it, but also understanding and managing the risks is crucial. Diversification, hedging strategies, and staying informed about macroeconomic trends are essential tools for any investor involved in the carry trade. Yet even with these precautions, the inherent risks remain high. While the carry trade can offer lucrative returns, it's a strategy fraught with danger. The potential for currency fluctuations, shifts in interest rates, and broader market impacts make it a high-stakes gamble. As we've seen with the Japan-US example in 2024, the carry trade is not for the faint-hearted. So the next time someone tells you that the carry trade is an easy way to make money, remember the tightrope walker, balancing precariously over a financial abyss. To stay updated on more insights like these, make sure to subscribe to Withdrawal Investing Insights on YouTube. Don't miss out on expert analyses, tips, and strategies to help you navigate the complex world of finance. Your journey to financial wisdom starts here.